Hey everybody, Chris Englebert with Englebert Financial Advisors in Allentown, Pennsylvania, and it's the first of the month update for April 2026. Can you believe spring is almost upon us? Well, obviously I'm going to recap March, and it has been exciting to say the least. Last year, if you remember, we began March with the tariff tantrums. Well, we had to top it this year in 2026 with the start of the war, obviously in the Middle East. And the first thing that did was cause oil prices to literally skyrocket to over $120 a barrel. So what did it do for the stock market? Well, guess what? In March, the S&P 500 was down 5.31%. A lot of the growth indices like the NASDAQ and anything large cap growth was down even more. I'll show you a slide in a minute about that. But then lo and behold, by the time you see this video, this week we already had talks of the ceasefire. Now, question is whether it's going to hold or not. And we literally had a 2.5% increase in the S&P 500 in one day. So again, you can see that from top to bottom, the S&P 500, it was down about 9.9% from all-time highs. We have then since recovered. We're down less than 1% for the year so far. But again, March was not good. So if you're looking at your March statement, or if you're online, you can see that March was not a great time. So what did we do? Again, these are the indices, and our theme this year is that what we call a return to normal. What we mean by that is the S&P 500 is not going to be the best returning place for the year. You can see commodity funds are up big time. Obviously, they're long gold and oil. But again, small mid-cap funds are up. All of these ETFs you see here, except the bottom two, are ones that we own currently for our clients. International is up for the year, mid-cap, value. You can see bonds are back to positive, but you can see as of this video, the S&P 500 is down about 0.61 for the year, while the NASDAQ's down 1.21. But you can see the Magnificent Seven, which we talked about ad nauseum, is down the most for the year. Now, having said that, I would not be surprised to see some snapback in the Magnificent Seven. Amazon, Apple, Meta is having a good week. Microsoft is struggling. Netflix seems to be stabilizing, but Tesla's sold off. And then obviously Google is doing rather well at this particular time. And Broadcom, which is considered the eighth Magnificent Seven stock, actually had a very good week this week. But again, you can see that diversification is going to be the key. Many of our clients have opened their statements or logged on and saw that, obviously they were down in March, but by April, first week in April, they're recovering so far for the year. What's happening with interest rates? We saw a huge whipsaw. When the war started, we saw the 10-year pierce the 4% level. And then as oil prices screamed higher, you can see we actually touched the 4.44% level on the 10-year. We are now getting a more normal 10-year right around the 4.25%, where we think there's a lot of value. And again, if you remember watching our videos all last summer, when rates were 4.25 to 4.5%, we were saying lengthen duration, lengthen duration, lengthen duration. Again, it looks like the Fed's on hold for the time being, because obviously they got to fight the inflation that's coming through from higher oil prices. But sometime in the third and fourth quarter, when oil prices, we believe, will start to ease, and we think then the Fed is open to having short-term rates come down. Right now, as of this video, a 3-month CD is 3.85%. A couple of weeks ago, it was down to 3.65%. That's pretty good value. But again, we think by the end of the year, you're going to see CD rates around the 3.25%. So just to sum it up, one of the most important things that happened recently is we run a tactical model. Our tactical model gets out of the stock market, gets back in the stock market. Last year, our tactical model was out of the stock market, and the stock market rolled over 20%, and then our tactical model got in. Unfortunately, it did not stay in very long, and it got out the first week in June. But the big news here is our tactical model went 20% long various U.S. and international indices. So our risk model is signaling that there's some value in the stock market when the levels were down about 9% for the year. Right now it's neutral. Right now we're holding position. Equity markets are still moving on war news. That obviously was very apparent this week when the ceasefire was announced and the stock market gapped up before the open, literally 1,000 points or 2.5%. So again, you're seeing a lot of news. There'll be a lot more news over the weekend. And again, the market's still moving, but it looks like there's some type of near-term conclusion to the war. And then guess what's happening? We got to focus on first quarter earnings season. Now, we think the first quarter earnings season is going to be obviously very important this year because companies are going to give you a preview of the second and third quarter earnings. And I can tell you right now, without going on any of the earnings calls, they're all going to say the same thing, that, you know, business may be challenged by higher energy prices in the future. We all know that. If you've watched our video from last month, we talked about the real concern is how high oil prices stay for how long. If we have a sharp reversal, oil gets back to $75 a barrel or lower, obviously this ripple effect of higher energy prices will be, you know, not a big effect on future earnings. But if we stay elevated with energy prices for the next 3 months, 6 months, you may see companies start to crank their earnings down, and that obviously is not good for the equity market for the rest of the year. But again, we had a lot of surprise here in April. We appreciate any calls. A lot of people are obviously getting their taxes done. We encourage you, after you have your taxes done, to contact us to talk about strategy for the rest of 2026. So that's the April update. We hope everybody is going to enjoy the finally warmer weather and get outdoors. We'll talk to you soon. See you next month.